I understand that Nike is out as well. Those earnings are. Sarah Eisen, of course, has that for us. Hi, Sarah.
Hi, Scott. Looks like it is a beat for Nike on the bottom line. 93 cents per share. The expectation was around 92 cents. Also on revenues, higher than expected on Nike. 12.7 billion was the revenue number. The expectation was more like 12.2. I'm sort of digging into some of the key numbers here. North America saw growth, 13%. That's good for Nike Bulls because they want to see growth in the key home market. China was the worry going in. The China revenues were down 13%. So that was actually a little better than expectations, both at the company and on Wall Street. Europe is also seeing growth at 17%. Of course, you got to strip out the currencies for some of these growth numbers because Nike's getting hit by the strong dollar. The weak spots in the report, margins, gross margin, 44.3%. That was a decline of 220 basis points. The company addresses it right up top in the release. They say that was because of elevated freight and logistics costs, something we know Nike's been dealing with, lower margins on our Nike Direct business, driven by higher markdowns. This was the worry, right? All this inventory was starting to come in, the ships coming into North America. The company has to discount the merchandise to just get it out of the stores. Not to say that they're not selling merchandise at high prices or at full prices, but they have to sell some of the last season stuff, and that hurts margins. Also, the dollar is weighing on the overall margin picture as well. The other sort of point that analysts are going to look at here are the inventories, which were elevated still, 44% higher. So on that conference call, we're going to want to hear how temporary the situation is, how long it's going to take to clear these inventories. But overall, I think better than expectations on growth, but clearly they're dealing with the promotions and inventories, which was the concern, Scott, going in. We're going to also get guidance on the call, hopefully, as we usually do. And
let me just ask you a quick question, because you know this company so much better than I do. I thought it was expected that because of the growth of their DTC, their direct-to-consumer business, that margins were going to hold up better than feared. And the story you seem to be telling me from what you're reading in the release and what you know is that maybe margins took a bigger hit than we otherwise thought they would.
So absolutely the bull case, Scott, on Nike, and this has played out over the past few years, is the shift to direct-to-consumer has been better for profitability and for margins because they're selling direct. They're not going through the wholesalers or the department stores. But now, because of all the COVID abnormalities and disruptions in the supply chain, they didn't have enough supply over the last few quarters. Now they have too much, and it's coming in, and it's coming in at the wrong season. So what's on the shelves right now, oftentimes they have current season, but they also, and they've been ordering, and they're bullish on the demand, but they also have back season, and they have to unload that. And inventories at 44% means that there's a problem there. So they have to be promotional, and that's going to weigh on margins, and hence the direct margins getting hit. So the question I think you raise, and this is a key one on the stock, is how long that's going to last. Because part of the bull case on Nike is that they have pivoted to direct. And they're continuing to see growth. Digital sales were up 16%. It's how long that's going to weigh on profitability. And also that strong dollar is wreaking havoc on this report.
Yeah, bad in the interim for the business, good for the consumer. If you're going to get a piece of the swoosh, you get a little cheaper. Sarah, thank you. That's Sarah Eisen with the update there on earnings. Steph, you own Nike, but I recall you thinking over the last, I don't know, couple years that the stock was expensive, not cheap.
Yeah, no, but I mean, it's lost 7 multiple turns since the beginning of the year, so it trades at 20 times 2024. Look, I think that there's a positive and there is a negative to this report. I don't think it's thesis changing either way. I think the bulls stay bullish. I think the bears stay bearish, but to see North America sales up 13%, China was supposed to be down 15 to 20%, down 13. Okay, that stinks, but it's a little bit less bad. And Europe at 17%. I want to dig through the numbers and see what kind of product by product. I think Sarah is 100% right on DTC. They have too much inventory. Inventory up 44% is huge. Last quarter, it was up 23%. So I want to hear what they have to say there, but it's not, again, not a surprise. They didn't have the inventory, so they flood the system with the inventory. And now you have to wait another quarter or two to get this run down. But to me, this is a quality company on sale, down 42% year to date rather. And if you're selling it on this quarter, that's silly because you really want to own this for the next 3 to 5 years. This is blue chip on sale.